let's talk about, well, maybe the active primary markets, the inactive secondary markets, at least on the small cap side, and more with Manishi Raychaudhuri, CEO of Emmer Capital Partners. Manishi, thank you so much for joining in. At the outset, though, thank you so much for waiting patiently while we were just finishing off a conversation and marking a new listing as well. So much appreciate that. But the patience that you have shown today, Manishi, are markets likely to show that patience with this bout of consolidation, if I don't call it underperformance, that we've seen? And what can lead it to break? Would it be the US trade deal with India, or that's not necessarily the big stumbling block now?
Thank you. Thank you very much for having me, and good wishes to viewers. It's a good day to be on Indian business TV channel. Just looking at the markets, one can't help but be happy. So, coming back to your question, I think there are a few things which are actually happening right now in India. First of all, the government's policy pivot seems to have changed a bit after years of focusing almost exclusively on investments. This fiscal year, starting from the income tax breaks and then maturing with the GST cuts, there's a degree of focus on consumption, which in a sense was long overdue. We are also seeing the RBI, which was actually quite shy of cutting rates aggressively for quite some time. But given that stupendous fall in inflation, both CPI and WPI, it is offering a very large room for the RBI to cut rates further. In fact, I would think that at least about 25 to 50 basis points, if not more, can easily be executed towards the end of this year and early next year. So if I put all these together, then at some point of time, maybe from the beginning of next year, beginning of 2026, we should begin to see earnings upgrades begin to come through. Even during this result season, we have seen signs of these earnings downgrades bottoming out, though it's only a few sectors which are benefiting right now. So I think, that process of, the earnings environment getting better, it is already beginning to happen in India, and that should lead us to better outcomes next year. India has underperformed. It's been by and large flat over the last 15 to 16 months, while other Asian markets, particularly North Asia, has skyrocketed. But I think there is, this incremental positivity about in the Indian market that we are seeing among the FIIs as well.
Manishi, hi, Tamanna here. And, it's, I think, a really good day that we're talking to you, because there seems to be more than just a little bit of a bump up in the markets. There seems to be a pivot coming in, and we hope it sustains, because this is the 26,000 mark is the hill that the Nifty keeps sliding off of. But our research team just put out this data that the Nifty PSU Bank has gained over 8 times from the COVID lows. Is it time for a very clear re-rating when it comes to financials and PSU banks in particular?
Financials is a sector that we are clearly positive on. And of course, our weight in the Asian model portfolio that we run is more on the Indian private banks, not so much on the PSU banks. But yes, I think both segments would benefit as a consequence of what we are seeing. And that basically, I'm pointing to both better asset quality. I think the most recent commentary from both the private and PSU banks is that the asset qualities are getting better. Second, I think in a declining interest rate scenario, the banks would not really have a major net interest margin expansion. Net interest margin might, just peak out or even decline slightly, but credit growth should actually accelerate. So this is, our basic thesis about the banking universe in India in the medium term. Over the long term, of course, we still remain resolutely focused on the private sector banks, because number one, they are the market share gainers. Over the last 20 years, we have seen, and maybe we will see that for the next 2 or 3 decades. And number two, their asset quality on an average is way better than their public sector cousins.
Okay. Manishi, the point is, I mean, a great time to bet on, let's say, the NBFCs versus the PSU banks might have been 2013, 14, 15, and then the ensuing 5 years, what a Bajaj Finance did versus an SBI was well documented. Now, the last 5 years, PSU banks have already done a serious bout of outperformance versus the privates, particularly the NBFC side, right? Is it time to think of a pivot again, or on a relative basis, do PSU banks still score?
I mean, as I just said, that my preference is clearly and unequivocally for the private sector banks.
But
now there's an
okay.
interesting point about NBFCs that you made, because NBFCs and the banks are actually characteristically different in one area, which is that when interest rates decline, it is actually the NBFCs that tend to gain because their cost of capital declines much more. So you could actually see, at least in the near to medium term, a significant outperformance from the NBFCs. But the problem here is that the good quality NBFCs are expensive. There's also a huge degree of differentiation among the NBFCs as far as their asset quality is concerned. So investors would have to be very careful in terms of stock selection in this sector.
Okay, I'm just wondering, Manishi, and this is a broader question, but I get a sense that market has not quite figured out what the impact is going to be on the 4 labor codes. Yes, on the face of it, very good. What we needed, it is that kind of reform that is required, and the government is coming in with those reforms. But in the short term, do you think it's going to shake up things in terms of compliances and costs for a whole host of industries that haven't really been on the radar yet?
Well, I mean, if I go by the commentary that I have heard from most of the companies, it seems that in the short term, there would be an increase in manpower cost. That is clear because these labor codes, they're trying to bring on the same platform, basically meting out similar treatment to the contract workers and the permanent employees. So obviously, the average cost of manpower is going to increase. But and remember that in India, if you look at in particular construction, some of those sectors like food delivery, etc., majority of the employees are actually contract or gig workers. So in the short term, we could see an increase in the manpower costs, but overall, for the longer term, this is obviously good for the general employment scenario because it makes hiring and firing a lot easier. And which obviously has a significant impact on the consumption environment overall.
Oil and gas and autos are the 2 sectors that I wanted your thoughts on, and particularly autos, Manishi, for all the fanfare around what auto sales will look like the last 1 month, post October 1st at least. Autos haven't been the star performers. So maybe they did a little bit of a bout of performance ahead of that, but then they've consolidated. Would the quarterly numbers, the monthly dispatches, etc., lead to further upsides there if you believe, by the way, that autos might show upsides?
Interestingly, you started your sentence with oil and gas, and I say that's interesting because just yesterday I put out a note where I look at which are the Asian market sectors which are actually seeing robust earnings estimate upgrades. Until recently, there was no Indian sector in that list. It was only, North Asia, China, Hong Kong, Taiwan, and a few ASEAN segments. Just yesterday and day before, one Indian sector entered that list of robust earnings upgrades, and that's oil and gas, which essentially is because of the oil marketing companies that surprised positively. But coming back to your broader question on autos.
Manishi, sorry. Because your answer intrigued me. So therefore my question is, because I know you've tracked oil and gas for such a long time, right? Are you constructive oil marketing companies?
I am, though I would rather play, I mean, even in Indian sliver of the model portfolio, I have Reliance Industries, which is kind of a proxy, not just to oil and gas, but to many other areas. So that is how I'm playing, because these companies, the dedicated oil marketing companies, remain highly cyclical. As of now, they're benefiting because of the benign oil prices and therefore the higher refining and marketing margins. But we tend to prefer more sustainable long-term stories. So did I answer that question?
Yeah,
Neeraj?
Manishi, you did. But I guess Tamanna has one final question, so we'll let the auto question go. Tamanna.
Yeah, no, please comment on auto if you wish. Manishi, my question to you was on how you're looking at primary markets right now. And
Right.
do you think that there are maybe some good steals there in the deluge of primary issues that are coming in?
Okay. First, couple of maybe 10 seconds on auto. We're positive on the universe.
Okay.
And I think, the kind of commentary we've seen, anecdotally, we've seen very strong growth estimates and, both in personal vehicles and in two-wheelers. We are more positive on the four-wheeler segment, particularly the market leaders, which have pricing power. Now, coming back to your other question on the IPOs, India is the second biggest Asian IPO market, possibly the fourth or fifth in the whole world. The time which is it's a great outcome because it's opening up new companies. It's making new companies, new sectors available for trading, which historically did not, just figure in the investable universe of India. And in a sense, if you look at last 3 or 4 years, many of these quick commerce companies, the food delivery and other e-commerce platforms, they have become available for trading. In a sense, India is going where China was about maybe 10 to 12 years ago. Now, the problem with individual IPOs is, of course, the valuations. After all, we like to believe that the intrinsic value of a company depends on the future cash flows that they generate and the volatility or the sustainability of those cash flows. So when one looks at this question through that lens, many of the present IPOs would actually appear overvalued, and therefore there's a lot of caution that investors need to exercise when subscribing to them.
A lot of them may seem overvalued, and maybe look at caution while subscribing. Wise words there from Manish Raychaudhuri. Thank you so much, Manish, for joining in.